Is the next big market move hiding in plain sight? Stephen Parker from J.P. Morgan Private Bank breaks down why a slowdown isn't a recession, which sectors could shine as the economy shifts gears, and if utilities are both defensive and offensive, could they become the new tech darlings of Wall Street?
Setting ourselves up for a growth recovery next year, and that's what markets are going to focus on.
In a slowdown environment, what sorts of sectors do you want to be in? Are you of the belief that big cap tech is growth in any environment?
Yeah, we still are big believers in the tech story. The AI story is only gaining momentum. 60% growth in AI-related CapEx last year, 60% this year. That's going to continue to drive us forward. But it's not just a tech story. There's other sectors with secular tailwinds that we really like, namely financials and utilities. We think the utility story is really interesting. Power demand is growing faster than the broader economy, a lot because of AI. Utilities, infrastructure are going to be the way to play that.
Both of those sectors have had quite strong runs. So all of the sectors actually that you like have had really strong runs year to date. And so I'm wondering how you think about utilities, because it's not necessarily the defensive sector that it used to be. There's an edge of offense as well when you layer in the energy demand from AI.
That's actually what gets us excited. We think that you have still some of those defensive characteristics. It's still highly regulated. You've got greater certainty around earnings. You have that power demand. You also have that attractive dividend yield. And if the Fed's going to start cutting like we think they will, that's going to become more attractive. But you get up something of an upside call option on this AI and power demand story, which is why we like the utilities.
For financials, I'm curious, do you like big cap financials or the smaller? And I'm thinking, if you take a look at some of the regionals, or if you go down the cap scale on banks, you might be looking for M&A to be a story. But the big cap, banks, some could argue are overvalued historically compared to themselves.
We don't think so. We think that the earnings power for the larger banks is actually stronger and more sustainable today than it has been historically. There's less economic sensitivity because of the diversification. We think deregulation is going to be a big part of this financial story, and that's going to benefit the larger banks because of capital return. It also potentially is going to benefit some of those smaller and mid-cap regional banks because we think M&A could pick up.
But just for an example, J.P. Morgan at a 2.4 price to book, that's not expensive in your view?
Well, again, we think a lot of the companies, whether it's the financials or in the tech sector, where valuations look a little bit expensive, it's because the fundamentals today are actually much stronger than they've been historically. You look at the diversified business model that a lot of these large cap banks have, you don't have the same sort of sensitivity. A growth slowdown like we expect in the second half of this year historically would have been really bad for banks. We don't think they're going to face the same sort of earnings pressure as they have in the past.
Stephen,